It was towards the end of World War II, and the US got together its allies to work on an international monetary system. More than 700 representatives decided to make the US dollar the world's official reserve currency.
And this basically cemented the dollar as kind of the central global currency from that point forward.
Other countries linked their currencies to the US dollar. Even after the official system broke down in the 70s, the dollar retained its influence. It's so widely used around the world today that even if the US economy suffers, the value of the dollar typically won't take a massive hit.
And there's what's called network effects, that the value of the dollar as kind of a key global benchmark for the pricing of goods, the pricing of commodities, for lending, the more people that use it, the more useful it is.
Today, more than 60% of all foreign central bank reserves and nearly 50% of the world's debt is in US dollars. For companies and investors, holding assets in dollars, such as treasury bonds, is seen as safe because the US is the world's biggest economy, and the US central bank is seen as a trustworthy institution. Just look at what happened during the 2008 financial crisis. The Fed lent out US dollars to other countries through one of the tools in its kit called swap lines. Essentially, the Fed gives another country's central bank, say Japan, a loan in US dollars. The Japanese central bank gives the US some yen in exchange. When the loan period's over, the two countries swap their currencies back and the US collects some interest. By April, the Fed had lent nearly $500 billion to central banks around the world. That number's come back down, but at its peak, the Fed's most recent currency swaps almost rivaled those of the Great Recession.